I want to talk to you about pricing. And before we go into a bit more of the tactical stuff, I wouldn't mind just going up a few layers, because there's a lot of noise in the market. Because it's such a big topic, it's quite an easy subject for people to create content on. There's a lot of noise in the market on it. And from our conversations over the last year or so, one of the biggest epidemics in the industry is fixed pricing, because profitability is just a massive issue, and scope creep, and all the stuff that comes off not having your house in order when it comes to fixed pricing. So I wouldn't mind touching on that. But if you go to the big topic of pricing and how we boil it down to the wise way of approaching it, where do we start?
Where do you start? Yeah, you start with your costs. Yeah, well, the most important KPI you've got in your business, and arguably in any business, is the cost of goods sold percentage.
Yeah.
So, and the reason is because the leverage factor of the cost of goods. So, and inversely, your margin, your margin in what you're selling is the most important figure in your business. Because if you've got no margin, then you're dead in the water.
Yeah. So where do most firm owners, because most firm owners would be in this bucket, there'd be a very small percentage of firm owners that actually have pricing right, if there's even such a thing, but where do they go wrong?
Where do they go wrong? Well, they go wrong because they don't know how to price.
Yeah.
So you in essence, you've just got to know how to price. And a lot of the time, they'll just do what the previous accountant's done.
Yeah.
Which is the wrong way.
So before we get into the your formula or methodology on how to price, can we talk a little bit about, you and I have known for the last 20 years, there's this debate around value pricing versus fixed pricing versus upfront pricing. Can you kind of distill from your experience, some of or demyth some of this stuff? So let's start with value pricing. What's your take on value pricing?
Well, maybe we step one step back from that.
Yeah.
So here's the concept, right? It doesn't matter what you do, it's how you do it. So in that sense, you can value price, you can fix price, or you can time bill. So all three can be successful depending on how you do it. So that's what I would say.
Yeah.
With value pricing, I'm a fan of it in the sense that you've got to be able to articulate your value. Most accountants cannot articulate the value, which is a sales process. So you've got to believe in yourself, have the confidence that the price that you're putting on something is worth it. Now, value pricing to the extreme is where you can price something like an extraordinary amount based on the success of tax save, for example. So there's a lot of arguments to and for and against that particular type of value pricing. I'm not so much in favour of that. I'm more in favour of someone having the ability to articulate their value around, a fair price that meets your KPIs. So, that being that your cost of goods sold are 40% and your gross profits 60%. So, yeah. And then the next one is fixed fees, of course. Fixed fees are fantastic, but you've got to be so careful with scope, creep, and seat that you don't drop profitability. Most firms that fix fee lose profitability because they start doing more work than they quoted. And then you've got the old model as well, which is WIP billing. And that's, I don't have a problem with that either. as long as you give your clients an estimate or you can manage the client's expectations. So in essence, the way to grow a firm is to keep the clients you got and get more. How do you do that? Is you manage your client's expectations. So if you can manage your client's expectations and value pricing or fixed fees or time billing, that's fine. If you can manage your client's expectations, you'll never lose a client.
So there's an argument that for most firms, they haven't increased their price for a long time, typically. And some of the advice that we hear, certainly in the coaching space, is one of the first things you should do is just go to your client base and increase all your prices by whatever, 20%, 50% in some cases, as a blanket sort of project. And the argument is, okay, some clients will leave, but there probably are the clients that you want to leave anyway. And with the increase in price, your work's actually going to decrease, because if clients leave, you've got less clients to manage, but you've still got extra revenue. So I'm not saying that's the right thing, but that's the rhetoric, that's the noise in the market. What are your thoughts or opinions or experience?
I'd say from my experience, most accounts are too cheap. Mm-hmm. Yeah, too cheap for sure. And even if you had 10% of your clients leave, the additional capacity that it creates for more profitable clients. So you don't want you don't want clients that you don't make money on. But what you want you want less clients that you make profit on. Mm-hmm. So yes, always increase your prices, but you should do it every year. Where you see firms go wrong is where they haven't increased their prices for 3 or 4 years, and then all of a sudden they want to jump them up to what's the new market value, and then the clients get a shock and they leave. Mm-hmm. So it's almost like when you... What's that?
It's the delivery part of that as well, because that's where we see a lot of the hesitation in that project.
Yeah. And even when you buy a firm, like a lot of people buy firms, and that firm might have cheap prices, which often happens with sole traders. But you can't go and change the prices the first year. You have to stage the price increase over 3 years. Mm-hmm. Once you've won the client's trust, you can normally increase the prices. A bit like the book Speed of Trust by Stephen Covey. Mm-hmm. So you can't increase your prices straight away. You normally have to do it over 2 or 3 years.
So let's go to approach to pricing and developing almost like a mini playbook for how you should approach pricing moving forward. So I don't know if you want to share your screen and...
Yeah, well, the first approach to pricing is to it's probably 4 steps. So the first step at a high level is work out the type of work that you have to do for the client. So work out the type of work or the type of service the client wants. And obviously you got to put that forward. The second step then is to work out in your team or in your business, in the firm, who's going to do that work. So that's the second one, who's going to do the work. The third step is, out of the people who are going to do the work, how much time are they going to spend on that work, right? And then the fourth step is almost like a given, is that the cost, and I stress the cost, the cost of the time that each of those individuals is going to spend on that work. So once you've worked out what that cost is in total, obviously then you can add your margin to it. Mm-hmm. And then if you add your margin to it, right, then you know what the fee is. And that's the perfect way to price.
So the perfect way to price is predicated on measuring time, right? And again, to the next big thing in the market at the moment, and has been for the last however many years, is kill timesheets. So let's touch on that, because it'd be wrong not to touch on that. It's a huge piece of the formula.
It's just so important that you track time, because if you track time, you can track efficiency. If you track time, you can track accountability. If you track time, you can track weaknesses that then lead to more training, to professional development. So tracking time has so many implications, and even though it mightn't be sexy, it's still the best way to be able to manage your accounting firm from bottom up, as Ed Chan says.
Not to go too far down the rabbit hole on this one, but what are the guys who are preaching from the rooftops of timesheets are dead and they're an old way of doing business, and like they have no place in the market? What are they missing? Like, what are they actually missing that's so obvious for us at Wize in terms of the importance of tracking time?
They're just missing the efficiency piece. And right. the reason that this whole no timesheet type scenario came in is, have a guess why? Fixed fees.
Yeah.
Right? Because traditionally, the only way to get a fee amount to bill the client was you did your timesheets and then you raised the bill.
Mm-hmm.
Right? So, and then, people logically then went, hang on, if I know what the fee is, why do I have to track the time? I don't need to track the time because I already know what the fee is. Right?
Yeah.
But what they forgot is it's about efficiency. So obviously when you value price, often you're not even looking at the way that they value price. They're not even looking at how much time it takes, right? Because they say that you're caught in the time for money trap. Because when you value price, you're just determining a predetermined value based on what you think, the value of that service or the value of that win almost is to that client. It's nothing to do with time in a lot of cases.
Yeah.
So the logic rapidly went down that path that, if I value price and then if I fix fee, I don't need to do your timesheet, right? And that's where it went wrong. Because
just hearing you say that, right, all the attention went to the top line number, the revenue number,
instead
of the most important number, which is the profitability number. That was
as I said at the start of the conversation, all the attention went to the top line when it should have gone to the profitability number. And the profitability, the cost of goods sold number, is determined by how much time people spend on jobs.
Mm-hmm.
Exactly. But it's good to analyse why this whole argument came down to no timesheets, because of value pricing and fixed fees. Right?
Yeah, I just find it fascinating because it's such a fiercely argued point by some people at the moment. It's like almost, what's the word?
Fanatical.
Yeah.
It's like fanatical.
Yeah. And it divides. It's divisive. It's almost like you have to be in the no timesheet camp or the timesheet camp.
Wardy, some staff will quit firms because they don't want to do a timesheet, and they'll go and work for a firm that doesn't do timesheets. Right? But what happens is when you have, say, often when you have less than 7 people and you have this concept of management by walking around, right? Often you can manage a team of 7 or less by brute force. In other words, you're in the office, you're seeing what people are working on, and via brute force and surveillance, you can manage people, right? And obviously, 95% of firms don't turn over more than $1 million. 95% of firms don't have more than 7 people. Right, so if you want to grow and scale, you don't want to have top-down management, like being in the office every day, like walking around seeing what people are doing. You want to have bottom-up management, and timesheets is just the way to do it. Mm-hmm. It just gives you the data. So if you fix fee or if you value price, you should always, best practice is say, well, I allocate 10 hours to do this job.
Mm-hmm.
There's 10 hours to do this job. But if that job takes 30 hours, right, and you're scaling above, the 95% that you don't want to be, how are you going to manage that when you've got 6 teams like me?
Yeah. Impossible.
You can't manage it, right? You've lost it. You've lost the plot.
Yeah.
So.
And then you're sitting there scratching your head as to why you're
not making money.
Yeah.
Yeah. Because I don't know the clients. Right, I can't even look up how long we've allocated that job and how long do we actually spend on it.
Yeah.
Right, and that's why I love the that's why I absolutely love and are fanatical about this little calculator.
Yeah. So walk us
Right.
through step by step.
Yeah. So step by step is we're gonna do a job.
Can
We're
you
gonna
just
do
tell
Bren's.
us, sorry, Johnsy, just one step before you start that. Why did we have
Yeah.
to develop this? I
Why
know
do
it's,
we develop it?
yeah,
Yeah, because firm owners and senior client managers don't know how to price jobs. That's
yeah.
why.
And it doesn't exist in any other software.
If you can
So,
find it, let me know.
yeah, perfect.
So here I'm going to put here, right? I'm just going to put Bren's financial statements,
Yep,
right? This is compliance at its core.
yep,
So we'll put Bren's financial statements in there, right? And so remember, like I said earlier, there's like those 4 steps in the playbook.
mm-hmm,
So first of all, determine the service that you want to provide the client. Secondly, determine who's going to do the work, right? So Anne Hathaway, she's a senior client manager, Anne.
yep,
So we add her in there, and you can see Anne there, right? So we know what Anne's charge out rate is,
yep,
right? So setting a charge out rate is another topic for another day,
mm-hmm,
but there needs to be some strategic thought around what that charge out rate is. And that's based on the person's salary. That's based on the market value of that person with that experience, with that skill that they bring to the marketplace. Right. So the charge out rate's a discussion. And then the next question, as I said earlier, it's like step 3. Well, how much time is Anne, who is a senior client manager, going to spend on this job?
mm-hmm,
Right? So arguably, she just does that final sweep, that final review. So it might only be, say, 3 hours on a substantial job. So as soon as you put the 3 hours in, we know what the fee is. Now, what I love about this calculator is it tells us the cost per hour, right, of Anne.
yep,
It tells us the gross profit and the percentage. And what the beautiful thing is, right, we can say, hang on, well, this is a set of financial statements. So we're going to get our senior accountant, Jennifer Anston, to spend most of her time doing this as a budget, right? We're planning. Quad 2, not urgent, important. Most people don't plan. It's quad 2. So what I love about this is you can go in on the time of the job and you say, look, I think Jen is probably, when you're a senior client manager or a firm owner, when you scope out, this is where you do your scoping. You look at the job and you say, look, that's going to take her 12 hours to do that because I've looked at the zero file. I've looked at all the situation, the entities and the structure of the client, right? And it's going to take Jen that 12 hours to do that, right? So then we've got Jen's charge out rate. We've got the time. We've got the fee, cost per hour, total cost, gross profit. And arguably, the lower level staff often have a higher GP in the ideal Wize team, which is fantastic.
mm-hmm,
Now here, you can see here, if we price this job at $1,530 and we actually do it in that time, right, we're going to make a 74% gross profit. Guess what our KPI is? 60.
we're in the zone.
Right? You're in the zone. And arguably, right, say that you take a bit longer, right, you're still going to recover it, but just say this is a fixed fee. So say you have to write some of that off. You can probably afford to write some of it off because the GP is 74, and if you did write some time off, you could probably arguably still come in at 60%.
Mm-hmm.
So the goal should always be the most advanced, highest level work possible done by the least experienced and inexpensive person. That's the Wize Ideal team. That's why it's always important to invest in those junior staff and keep stretching them, keep expanding them.
So just as a side question there, because it seems to be popping up a little bit recently, especially with our Northern Hemisphere clients, is, we can't find staff that are experienced and have the skills across tax and bookkeeping, and so we have to silo our teams. Like what's your answer to that? What's the antidote to that? Because the ideal team works for 7 teams for you and hundreds of teams around the world. So what the guys who are coming back saying, no, we have to have silo teams.
No, that's just, Brenton, that is simply limited thinking.
Yeah.
Right, limited thinking, because have a guess what? Most of those accounting firm owners, right, they know accounting, right? They're the owner of the firm. They know accounting and they know tax. And to say that you can't train or you can't teach other people what you know, that's just a limiting belief, right? If you think like that, that's what you're going to get. I think the opposite. Everything that I know, I wholeheartedly, authentically believe that I can teach someone else what I know, right? Yep. That's a belief. But what you think is what you'll get, right? Like, look at you and I. Are we both human beings?
Yeah.
I don't care whether you're from India, Vietnam, or wherever you are. It might be harder or easier for some, right? But part of your hiring process is hire the right people with the right DNA, with the right potential to do that role. But a lot of these firms, they will say that people can't fulfill their full potential. People can't, they'll say people can't do bookkeeping, or they traditionally, what I read the other day was they can't do accounting and they can't do tax, right? But here in Australia, that's like so different in our thinking, because the bookkeeping, right, and the accounting is the absolute fundamental and foundation to a set of financial statements. And have a guess how the tax is done in a compliance business. It's done from the financial statements. Yes, there's tax involved in it, but it can be learned.
Yeah, love it. So where do we go to from here? We've got our proposal calculation done.
This leads straight into sales. This leads into then articulating your value. This leads then into your USP, your unique selling proposition. There's 10 accountants in my town. You need to have an answer why they come to you. Yeah. The unique selling proposition. So, and people don't like to be sold to; they like to buy. And you'd always rather buy from a friend than a salesperson.
Yeah.
So, partner gives it the final.
So can we just touch back on that again? Old way versus new way. Old way versus Wize Way when it comes to pricing.
Yeah, the old way is that you hire a superstar and one accountant does everything. So they do, the setup of the job, they do the importing, they do all the journals, they do all the working papers, and they even try and check their own work, and the partner just does the last 15, 20% of the job. The Wize Way is that the bookkeeper does their part, the senior accountant does their bit, the senior production manager does the quality review or sweep of the job, which is only limited hours anyway, and then the client manager does the final bit. So you get this team effort, but the people at the lower end, their cost is much lower than the most senior people, and arguably so you can get just as good, if not better, profitability in a team environment. That's the Wize Way.
Are we missing any other big gaps in the conversation around pricing? Anything else that comes up time and time again for you when we hit pricing?
I think the biggest thing is that people don't increase their pricing with inflation.
Yeah.
Wages go up tend to go up every year. People just are scared to increase their prices. That's what I've seen.
So if we look at the root cause of that, is it just a fear? Clients won't accept it.
Lack of time too. Lack of time, because particularly if you're fixed fee, it's easy just to send out the same fee every year.
Yeah.
So I'd say lack of time, lack of management, lack of being organised, lack of planning. It's quad 2 activity. So yeah, and then I mean, look what I've just showed you here. This is planning. This is at its core, not urgent, but important. The easy way to do what I just did using that tool is to say, oh, I'll just have a guess. I think it's worth this.
Yeah.
I think, I think that here's a job. I've seen this before. I'm not going to go into the detail. I'm too busy. I reckon it's just worth $1,500. Or I reckon it's just worth $1,200. Right. But this is the whole point, Wardy. What you don't measure, you can't manage.
Yeah.
So you're not measuring anything. You're not planning the job. You're not even measuring how much time is spent on the job.
It's also quad one thinking or short-term thinking, because for the time you save of plucking a quote at the start, you lose in profitability at the other end. So, like it makes much more sense to, we saw how quickly you put Labco together. Obviously, there's more to it from a planning and review. But
it's just scoping it out. Yeah, it's scoping it out. Like Ed Shannon always say that, you make or break your money on the scoping. And the scoping is working out who needs to work on the job, and how much time that person needs to spend on the job. If you've got those two things, you know what the charge out rate is, so you can price the job effectively. You can also look at the gross profit. It's just planning. It's good management.
Yeah,
it's good management to have a map to know where you're going.
Love it. All right, I'm going to stop there.